Good evening, everyone, and welcome to the webinar today. I wish everybody a very happy new year. My name is Yogesh, and this webinar is powered by Century Financial. We are an investment consultancy located in Emar Square, and it's been an eventful 2023. We'll do a quick recap of what 2023 has been like, and then we'll jump to the Global Investment Outlook 2024. I hope that everybody had a great year, and I only wish you a great and a very happy new year. 2024, like every other year, financial markets bring something different on the table. 2024 is going to be no different. It's going to be a year full of events. It's going to be a full of opportunities, and again, it's going to be a year full of extreme volatility, with geopolitical tensions arising and US elections being the center stage. I think 2024 is also going to be very volatile, and that's why we are here to discuss the research reports which we have generated, and to take you through that how 2024 is going to be like. Just to show you a quick recap of 2023 it has been. I hope that everybody can see this. Please use your chat options to ask any questions if you have. If you can hear me properly, or if you have any questions, you can use your chat options to ask me any live questions you have regarding. A copy of this webinar will be put on YouTube as well. So don't worry about it. You can always review this webinar later. Now, to give you a brief idea what 2023 has been like, this is a snapshot for the major instruments in 2023, what you see right now. And sorry, just look at the some of the best and worst performing stocks in 2023. If you see the major stocks like Nvidia, for example, Nvidia, the total return in 2023, the Nvidia stocks went up by 239%. Facebook stocks went up by 194%. Royal Caribbean Cruises, the stock went up by 162%. Uber stocks went up by 149%. Carnival stock around 130%. Advanced Micro Devices, AMD, a chip making company, stocks went up by 128%. Tesla went up by 102%, and Salesforce went up by 98%. You must also know that Nasdaq, which is a tech-heavy index, went alone up by 53%, which means that if you had done nothing, just invested in an index, your portfolio will be up by that much. But obviously, what has happened last year has happened. This year is going to be again full of different opportunities, and that's why we need to be clear. And if you see the stocks which haven't performed really well, Enphase Energy down by 50%, Dollar General down by 44%, Moderna, Pfizer, and Estee Lauder each down by 45, 41, and 40%. Just to have a glimpse of the performance of the cryptocurrencies in 2023, as you can see, Bitcoin went up by 153% in 2023. Ethereum went up by 91% in 2023. There has been a huge comeback in the cryptocurrencies. And if you see the performance of key indices, as I was saying, the US stock market index, S&P, Nasdaq, S&P went up by 26% this year. Nasdaq recovered from the 2022 lows and recovered and went up by 55%. The small cap index went up by 17% in US. The Europe 50 index went up by 23%. Nikkei, which represents the Japanese companies, the benchmark for the Japanese economy, 31% up. UK index went up by 8%. Canada, Netherlands, Nifty each went up by 12, 17, and 22%. South Africa index went up by 9%. Australian index went up by 14%. Hong Kong went down by 10%, followed by China index. So China did not have a very eventful year, and the stock markets, the benchmarks ended lower around 10 to 9%. So we have seen most of the economies, especially US, rallied this year, while Chinese economy lagged behind. If you see in terms of major currencies, dollar index, the first one went down by 2%. The Japanese yen again down by 8%. We have Swiss franc, which showed a great strength, 9% increase, Euro 3% increase, GBP and Chinese yuan up by 5 to 3%. And this is the performance of 2023. If we see the performance in bonds, the treasury bonds ended the year with 1% decline, while the Euro bonds prices went up by 5%. Performance of major commodities in 2023, how it has been. Gold prices ended 2023 with 13% increase. Copper prices ended up 2% increase. Silver, along with oil, we saw the silver down by 1%, Brent and WTI down by 10 and 11%. Gasoline prices. So if you see the energy market, we saw a big decline in the energy market, along with agricultural commodities. Wheat prices ended 2023 down by 21%. Corn prices down by 31%. Palladium and platinum in metals down by 39 and 8%. Natural gas, drastic decrease, around 44%. This has been a quick review of 2023. So we saw the best performing markets were US at the moment, and within metals, gold appreciated well. Energy prices took a nosedive, followed by cryptocurrencies again coming back in double digit, three digit growth in 2023. Now, this being said, this is what we saw in 2023. However, it's going to be the year where a lot of volatility is going to be generated. So, to understand how 2024 is going to look like. So, just to give you an idea, uh, 2024 has been one of those years, 2023 has been one of those years where we have seen very aggressive rate hikes to control inflation. And we are quickly going to review what happened in 2023, as we just saw the performance of the metals and the commodities and the indices. And here, if you see, this is the important update right here. The Federal Reserve held the interest rate steady, 22-year high, around 5.2 to 5.5%, which made bonds a very favorite instrument for a lot of investors. And if you see here, the Magnificent Seven, the mega cap stocks, Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, these kind of companies have contributed significantly to the S&P 500's 2023 gain, almost 55%. So the S&P 500 moved up by 25 to 26% in a year, and 50% of that growth, more than 50% of that growth, was accounted because of these stocks, the Magnificent Seven, which went up. So, and we are going to talk about tech stocks a lot, because we have seen that tech stocks 2023 had a good year, and not because of the hype, but because of the fundamentals as well. And 2024 could be that year where a lot of tech companies will rebound, and we will see a lot of growth in the tech areas. Now, as far as the inflation is concerned, in 2022, the US inflation went up to 9.1%. And we saw in June 2022, the inflation got reduced from 9.1% to 3.1% in 2023. There were nonetheless 11 interest rate hikes and a very aggressive tightening which happened, which means that central bank increased the interest rates to control inflation, and that actually worked. That the inflation, which was 9%, came down all the way to 3%, and now is expected to drop further by the end of 2025. So the idea is that currently Fed is at a point where it's thinking whether the interest rates have increased enough, and they are the central bank of US, as we call the Federal Reserve, is beginning to see a more straightforward path to price stability. So the central bank has observed the energy prices have come down, especially oil, gasoline, utility gas. Smaller than expected increases in food and new vehicles and shelter prices, along with slight decrease in the price of used trucks and used cars, which also elevated some of the burden on consumer expenses. Now, talking about US, and jumping to Europe, because in eurozone the inflation did fall down to 2.4% from 2.9%. And the European central banks also increased the interest rates, but the moment they increased the interest rates, they saw that there was an adverse effect of the high rates on the major economies like Germany. And we saw that German economy dipped into recession in 2023. So that made the European Central Bank keeping the rates unchanged and not increasing again. Now, it is expected that most likely the European Central Bank is going to keep the rates similar or probably reduce it because not it's impacting Germany in a very adverse manner. But Europe is also stuck with a lot of geopolitical issues because the Russia-Ukraine war adversely impacted European economy, and that's why we saw the energy prices went up in Europe. Even the Chinese reopening could not push European economy higher because most of the companies in Europe are service based, while the Chinese the most of the Chinese economy, when it rebounded, it the rebound was in the industrial sector. Now, a roadmap for the investors in 2024, as we can see, what we have to understand is it's going to be a year where there are four scenarios, and we have to see what is the probability of all the scenarios. So, as you can see from the report, we have seen the last quarter recovery in 2023 has changed. So in last quarter, the recovery was very phenomenal, and it changed actually how we are going to see the economy in 2024. So basically, if you see the US inflation data, it did come down, and we have seen history has shown that markets have always been over optimistic during the downturn cycles and pessimistic during upturn cycles. This is something which happens a lot with the investors also. When markets are going really high, they always feel that it's going to come down, and when markets are coming down a lot, they feel that now at any point of time it can reverse. So something which has always been seen, and there is a lot of geological stress points. Overall slowdown in Germany and China. This will continue to linger in 2024. So as long as we are away from, if you're looking at German equities and Chinese equities, the slowdown will continue in 2024. There are a lot of scenarios, and if we have seen every single time when the inflation has come in US from 1965 to 1982, the interest rates have gone up, but again, after going up, the interest rates again have started coming down and have settled, and it has created a lot of volatility also in the markets. So currently at this point of time, a lot of market participants are actually expecting Fed to either keep the interest rates same or cut it down. As per the January meeting, FOMC, they said that they are going to be very cautious before they increase or decrease interest rates, and they are going to keep a check on the data. So the scenarios which we are seeing is soft landing, hard landing, growth in full throttle mode, and caution and heightened anxiety. Now, the caution and heightened anxiety, the probability is of that happening is basically 10%, but the higher chances are of a soft landing, in which case equities and bonds both should get a push. Then I'm talking about soft landing. Soft landing means as we see the economic data, uh, consumer spending has declined, and that's good because inflation is under control. Central bank probably could follow a very less aggressive stance and do not increase the interest rates. In fact, they can cut down the rates also. That's going to be again, it's a scenario. It's not something which is going to happen. This is one of the scenarios which have the higher probability of happening, that where we see that there might be some rate cuts, and that should favor stocks and bonds both, and that is a soft landing scenario which has a 50% probability to happen. Then there is something called a hard landing. Hard landing means that we might see a sharp slowdown in growth, and the US economy entering into recession. And any recession scenario will likely see the US again aggressively cutting down on the interest rates. And a hard landing would definitely, as you can see, might put equities down, but again continue to put bond prices higher. as under a hard landing, we might see US economy dipping into recession and rate cuts might start happening. Then there is something called, so during the hard landing, we also see that a lot of people would start investing into commodities like gold. And as we have seen that the year of 2023 has been very positive for gold because of the geopolitical issues and the anticipation of inflation being under control and rate cuts happening in January, we have seen gold prices have bounced and continued to go higher. We have another scenario which is growth in full throttle mode, something which the chances of that happening is slightly less, but we are talking about a very positive scenario. There is no negative impact on the US economic growth, and under such a scenario, equities could see a positive return, while bond returns could be flat to negative. And again, it's based on more growth. And this is something where, if you see, under a growth in full throttle mode, we might see equities jumping back, and the probability of that happening is 15%. Lastly, the fourth scenario, which could happen, where the probability of that happening is slightly less, is the caution and heightened anxiety, under which we will see that there is too much anxiety among the investors. Overall economic growth is stable, but rise in oil prices and geopolitical conflict should keep the stress points alive in the market. And as we know, the higher long-term inflation, if the inflation continues to increase, that will again uh, uh, might push central banks to increase the rates. Again, that will increase the bond yields. Also, it would might push equity prices down. So, a caution and heightened anxiety, the probability is expected around 10%. But we would like to keep all the four scenarios for 2024 open, and that's how you need to plan your investments. A major diversification between equities and bonds is absolutely needed, apart from a few different strategies. To see a very country specific outlook, if I were to see US, the growth rate of US has been adjusted slightly on a lower rate, and at this point of time, obviously the inflation is under control, so equities have gone up. Um, the service inflation and the physical goods inflation both have shown signs of slowing down, and rents have also come down. So a fall in inflation is again leads to fall slowdown in wage growth. Now, this is something which is very important because um, uh, if the inflation is under control, the central bank doesn't need to raise any more rates, and markets are hoping that Fed will not lag in the rate cut cycle if the inflation starts falling below 2%. Currently, it's around 3.1%. Also, another thing which has happened in US is um consumers they have maxed out on their emergency savings fund, and the credit card spending rate has increased, and the interest rate on the credit card is also higher. So that has again pushed the consumers to cut down on the spending, which has also started affecting inflation on the downside. Now in Europe, again, eurozone is expected to post weaker growth for 2024. The cost of living is higher. They have increased the interest rates in the past, and that has impacted Germany a lot. It has technically dipped into recession, and currently, as of now, Europe is between the Russia-Ukraine war as well. The German economy has grown in only two out of last 6 quarters. So this is something which has impacted Europe a lot, and I think that there is going to be one of the most important events in 2024 where the Netherlands elections are going to happen. And if the Netherlands election is something to go by, the rise of the right wing and ultra conservative leaders, as we can see in the report, it might threaten again the Eurozone's integrity. So the Netherlands elections are again going to be an important event, but as of now, we are expecting Eurozone growth to be slightly on a lower side, with Europe being in the center of Russia-Ukraine war, higher energy prices, and a lot of geopolitical tensions. And if we see from the Asian side, China it did not have a great year, and the Chinese economies we have seen it in 2023. the Chinese economy, actually, the Chinese stock markets, the benchmark stock markets actually fell down by 10%. And as of now, also in 2024, the recovery is not expected to be very exciting unless China announces more stimulus for the economy. Because currently they are going through a tough real estate crisis. The existing home prices have fallen down, and that is something which we have to see, because the real estate sector contributes more than 40% of the economy, and it's a proper, and China needs a lot of stimulus to get out of this. So unless that happens, we feel that China in 2024 is also going to be slightly dismal. And the rest of the Asia, excluding China, if we see the Southeast Asian or other economies, if we see Japan, for example, for the I think for decades Japan has been under deflation, and now finally Japan has also started experiencing inflation. Now, inflation in Japan again, while US is getting out of inflation and trying to reduce rate cuts, Bank of Japan is experiencing inflation, so they might go for increase in rates. So this will create a policy divergence, which means while US reduces the rates and Japan increases, it might affect dollar yen as a pair. So if you have a trade in dollar yen, be very careful. 2024 yen might get more stronger against dollar. If you see the Japanese index also, I think uh, the indices have the Japanese index also in 2023 popped up on the basis of higher export earnings, more foreign revenue. Even for India, I think 2024 general elections are going to be really, really important, because it seems like a no-brainer at the moment, but looks like if the current leader continues, markets will be absolutely expected to go higher post elections if the current leadership continues. Any different outcome other than what we have currently in India, that might create a big sell off in the Indian equities. So, post general elections, I think it will be a lot clearer than how markets are going to be like. If you see GDP numbers from Malaysia, Vietnam, Philippines, again, it's been an upside for all the economies, including Indonesia, Malaysia, Singapore, Thailand. All of these, the average growth has been around 4.6%. Again, these are the countries. If there is a major energy shock, oil prices going higher, it will definitely affect these economies. But as of now, I feel that the energy prices are down, and that has been supporting these economies. GCC, as we know, that they had a great year with uptick in oil and energy markets. Investors have invested a lot in GCC markets. US and Europe were a lot more volatile, and there were not much IPOs. But in GCC, the IPO game has actually begun, and we saw big Dubai names like Salik, Empower, they're up around 40% from the initial listing prices. So that is something which we see, that a lot of new IPOs coming from GCC, and coming up with really good dividends also. I think if you see companies like Qatar DSM, which have given around 6% in annualized dividends, I mean, this is something which is really good, because if you compare this to the US market, most of the dividend yield is ranging between 2 to 3%. But if you see now, a lot of stocks from GCC are giving you more than 4%, around 4 to 6%. So you can try to diversify your portfolio in within the GCC economy also. Major themes which you definitely should keep a watch on at the moment. Um, in the recent OPEC meeting, we saw that Saudi Arabia has talked about output quotas for African members. So far, OPEC has been successful in managing the oil prices. But in 2024, again, as we see, the production cuts are of essence, and we'll see that what is the expectation. Overall demand growth set to slow, general markets could shift into surplus. Possibility that there could be a slight decline in the demand for crude oil and the oil surplus continues to be in 2024. But at the same time, if you see, IEA, the International Energy Agency, has raised their oil demand growth forecast from 930,000 barrels per day to 930,000 barrels per day from 880,000 barrels per day. So that's actually good because if interest rate cuts happen, and the oil prices have also fallen down recently, that could spark a new demand, and that again can push oil prices higher. But we'll see, because again there are a lot of geopolitical scenarios. Uh, if there is any other Middle Eastern conflict, and if it disrupts the oil supply, that would cause lower economic growth and higher inflation. So we will see what happens, because um, China oil demand growth is actually easing in the first half of 2024 to 4%. In China, the consumption from aviation and other sectors will probably be negated by weak diesel usage. Number wise, OPEC is an organization which looks after the supply of the oil, and the members include Saudi Arabia, which is one of the largest oil producer in the world. So number wise, we see that Chinese demand averaging 16.4 million barrels per day in first half of 2024. IEA estimates put demand numbers much more higher. So I think this is going to be one of those years that, if since oil prices have declined, we might see demand coming in. But again, if geopolitical issues come across, that might disrupt the oil supply and might lead to a lower economic growth. Another very eventful, something very eventful which is going to happen in 2024 is US presidential elections. And this is really important. Why? Because every time US elections have happened, a year before and a year after, let me show you some statistics over here. This is since 1964. The performance of S&P 500 12 months before the election and then 12 months after the election, and the calendar year, the annual return for that particular calendar year has been most of the time positive. So if you see since 1964 till 2020, there have been instances like in 2000, George W. Bush um, came in, and the calendar year growth was minus 10%. In 2008, but during Barack Obama, again the calendar year growth of S&P 500 was 38% negative. But in 2008, we saw US recession. In 2000 year, we saw the dot-com bubble. So those are the negative growths. But otherwise, during the normal market situations, what we have seen is every time US election happens, mostly the calendar year annual return for S&P 500 is on the positive side. And 2024 is going to be again one of those years when the US elections are happening. An average return what S&P 500 has produced during the calendar year has been around 8%. So this is something which you must understand, because on the day of the election also there is a lot of volatility. Now, looking at the evaluating some stocks for 2024, uh, 2023 was highly driven by tech, and I must tell you that 2024 also could be the year where a lot of industries related to semiconductors, internet, software, computers, aerospace and defense, AI, cloud computing, these kind of sectors are again will continue to rule. And that's really important, because not just these the companies in these sectors are only hyped about. It's not just the hype which is pushing these companies higher. These companies actually have shown healthy balance sheets, and the debt levels are really low. The profitability is consistent, and they have shown enough resilience to withstand the economic headwinds. So we are talking about these companies which are fundamentally strong and have are a part of the sector which is going to be more and more important as the years pass by. So if you see, these are the few stocks which we are looking at 2024. Again, we are looking at, this is completely tech. As per every investor, it depends on what sort of risk appetite you have. Tech stocks are slightly more riskier than value stocks, Value stocks give you decent amount of dividend. Tech stocks do not give you any dividends, but the capital growth and the volatility in tech stocks can happen a lot. So these are the few stocks which I would like you to have a look at. Keep a track on this. Um, these are very volatile stocks, by the way. So if you don't like too much volatility in your portfolio, you must check with your risk consultant that what it is going to be like. Now, stocks like Nvidia, Alphabet, Microsoft, Facebook, CrowdStrike, Adobe, American Express, Amazon, Netflix, and General Dynamics. So again, if you have to invest into these stocks, don't invest all your money at once. This is something which becomes a part of your ladder portfolio. A ladder portfolio basically allows you to invest a small percentage to begin with, and if the stock price falls further, you put another percentage, and then when it falls further, so over here we have given you these 10 stocks and their prices, and we have also guided you that when should be the entry points. As you can see in Nvidia, the first point of entry could be 488, second point of entry could be at 454, and third point of entry could be at 429. Can it go down more than 429? Yes. But as per the technical and the fundamentals, these are the three prices at which you can plan your entries. So, for example, as you can see, that if you have $1 million, don't put all your $1 million at once. Put 25% first into these stocks, and then the remaining 35%, and then remaining 40%. So you can get the best of the entry points. A small explanation of all these companies is also, so this report will, you can easily talk to your relationship managers, and you can get a copy of this report where a lot of description is given about these companies which we have picked up. As you can see, like for Nvidia, the sales in the past 9 months stem from China, and recently the US government levied sanctions on high performance chip exports to China. Now, this is something which is expected to put a dent in the revenue from this region. But NVIDIA is reportedly designing three distinct AI chips, which is specifically tailored for the Chinese market. So again, in spite of the US export restrictions, they are tailoring something very specific for the Chinese market, and that is why Nvidia is up at its game, and Nvidia's market cap has also gone up to $1.2 trillion. The entire 2023, Nvidia has dominated among all the tech stocks, and the recently company launched NVIDIA H28 200 Tensor Core GPU, and it's the first GPU to offer 141 GB of HMB3 memory. Uh, to give you a easy perspective, NVIDIA is a leader in the graphic chips, and currently, as we see the world, every single technology which is coming in requires high efficiency graphic chips. NVIDIA is manufacturing those. So that is something which is really going to keep the stock in talks for entire 2024 as well. We have Alphabet, we have Microsoft. Again, as I said, that the copy of this report can be sent it to you, and you can have a look at it and read about these. Anything which you don't understand, please feel free to talk to us, and we'll definitely explain to you that why the stock could be a good fit in your portfolio. Again, there are a lot of risks prevailing since it's a tech. These are all tech stocks, and tech market is very cyclical in nature. Whenever interest rates go up or inflation is high, the tech stocks are first to fall down. But as we have seen that inflation is under control and central bank is talking about keeping the rates same or lower, this could be the year for the tech stocks as well. For those investors who invest into a lot of funds, off lately there has been a few funds which you have highlighted. Gold shares, SPDR Gold Fund, um, China Internet ETF. So Chinese real estate is not doing really well, but there has been a rapid proliferation of AI, and a lot of regulatory crackdowns have been removed from the Chinese tech sector, and that is producing a lot of opportunities in the country's internet and tech sector. So there's a fund China Internet ETF, which you can invest into. Again, consult with your risk experts and look at your risk appetite, and then see it. There is a fund which is related to Greek economy, Spain, and Mexico. And to give you a slight explanation for that, Greece economy has rebounded strongly on the back of burgeoning tourism sector, structural reforms conducive to economic growth. Spain is about to receive 163 billion euros from the EU Recovery Fund, and that is expected to boost the renewable energy and e-commerce and biotech sectors. Mexican stocks are projected to experience another spurt of growth, a lot of economic expansion. So I think this is something slightly different from your regular investments. And again, it's all about diversification. Every year, you must diversify with different asset classes, because that's what keeps your portfolio alive and helps you to protect your portfolio from market volatility. Um, Investing into different asset classes is something what you should be looking at. Again, a small explanation of all these funds which we have talked about. As you can see, the Chinese internet stocks have been beaten down in recent years due to regulatory crackdowns, but now there have been signs of shift in stance in the beginning of the second half of 2023. There's been a lot of negative press, a lot of regulatory hurdles, but Chinese internet stocks have again done well to grow their business in line with their US counterparts. So you're looking at stocks like Tencent, Alibaba, Baidu, which have increased their investments in AI, and a lot of productive areas such as generative AI. A lot of Chinese internet companies are cutting down their cost as well. So the 52-week low and high, if you see, the 52-week low for this fund was 24. Last price was 25.8. 52-week high has been around $36. Dividend yield is around 1.6%. So it gives you a different sort of exposure. Same with the Greek equities, which is basically compassing 26 stocks with financial dominating the sector allocation. And the Greek fund, is basically maintains a diversification. It includes industrials, consumer discretionary, utility, consumer staples, real estate. So the fund has actually witnessed a growth of 6% in 2022, and in 2024 again it is expected to grow. They have delivered good, remarkable returns in 2023, outperforming peers in the European region. Greece does not hold a very good reputation otherwise, but 2023 has been one of those years where Greece has given good returns as compared to their European counterparts. And as I said about Spain and the Mexican ETFs, Mexican stocks are also poised for further growth in 2024. And there's expected to be a lot of economic expansion, which will be happening. Local businesses, especially which are tied to real estate and construction, are very positive about attracting investments from companies which are relocating to Mexico. So the growth is expected to increase by 2023 and by 2024. And again, as I said, that there's going to be presidential elections also for Mexico in June 2024. Um, this is something which all of us have to see, guys. Again, when we look at our portfolio, it's not just gold or oil or some stocks. We need to diversify well. And as we can see, apart from equities and commodities, now we are looking at the bonds as well. And corporate bonds look very attractive. We have created a corporate bonds portfolio back in the past. And as the US government bond yields are around 4%, 5%, the corporate bond yields also look very attractive. Companies like Citigroup, JP Morgan, Wells Fargo, which are giving a coupon of around 4.4, 4.25, 4.3 dollars as well. And the yield to maturity is around 5.2%, very close to the government bonds. But then these are the companies which we are looking at. These are investment grades, something which are much more stronger. So I think if you're looking for the corporate bonds, look at the investment grades. They have a stronger credit worthiness. Bonds related to Citigroup, JP Morgan, and Wells Fargo. Um, Otherwise, if you see other bonds as well, uh, so we have done analysis of their default grade and default probability, and that might really help you to understand that why we have picked up these bonds. We have looked at their debt equity metrics also, return on assets and the assets liabilities. We have done scenario analysis, liquidity assessment to understand that how liquid they are, and at the same time, what is the chance of the default. And all these companies have lower chances, and that's why we have put these companies into the topmost corporate bonds together. And US Treasury bonds still remains the gold standard. And the US government bonds holding a AAA rating. It's a very good credit quality for US bonds. The interest rate is around 4.7%, 4.2%. And without a doubt, in last 10 years, the interest rates have always been lower. But in 2022, due to higher inflation, the Fed increased the rates, and that's why bond has become one of the most talked about investments. And it's a no-brainer for a lot of investors to invest into US government bonds and get good yields as well. Now, the projections of the path ahead, as we said, that the inflation is expected to come around 2% by the end of 2025. And throughout the year, uh, looking at the geopolitical issues and the data, Fed is going to decide whether to keep the interest rate same or cut it down. A cut in the interest rates is highly anticipated since the inflation is under control. Scenario analysis for a lot of treasuries, if we see, like the treasury bond, which is maturing in 2025. So continue to buy bonds which are maturing smaller to medium term, and they're giving you a good interest rate as well. So even if the bond yields go up or come down, these are the scenarios which you might see in your portfolio. The bonds which are maturing in 2028, the bonds which are maturing in 2050, and slightly higher perpetual bonds. So the idea is that bonds and equities should be invested into, but at the same time, as I said, tech stocks can also be a part of your portfolio this year. 2023 was very good for tech, and these companies have shown strong durability. These companies have shown a lot of positive growth, and the balance sheets are actually really strong. And apart from that, you can always have a look at other economies like Greece and Spain and Mexico, and invest into these economies through funds always, because the volatility is less, and that is something which is really important. Apart from this, there are a lot of strategies which we as Century, as investment consultants, we do, and these strategies are related to market neutral, a lot of arbitrage. Again, nothing is risk free. um, a lot of you asked in the question that what are the chances of uh, you know how much guaranteed it is. Nothing is guaranteed. uh, 2023, every year has come up with different set of challenges, and the only way to uh, invest in either of these years have always been to diversify. If you see that 2024 rate cuts are going to happen, it's good for equities. Uh, Also, at the same time, good for tech stocks. If there are geopolitical issues which are expected to happen, continue to invest in bonds. So this way, we have to have a portfolio which is diversified into different markets. We just saw that how Chinese equities in 2020 haven't performed well, but the Chinese tech sector is climbing back. We saw that GCC companies are doing really well, giving you really good dividends. Japanese stocks are higher, followed by Malaysian, Vietnam. Indian stocks post 2024 elections again could show a lot of positive growth if the current leadership comes in. So the key is to keep yourself diversified into different sectors, and I think that should definitely be our 2024. Watch out for US elections, and if you're a trader, US elections is one of those times where you see a lot of volatility in every single asset class. So talk to us more, and if you have any questions, please let us know. The idea is to give you a brief snapshot of what happened in 2023 and how 2024 is going to be like. If you want to discuss this report further, please let me know. I can be available for a one-on-one session as well, specifically designed for you. And we do these webinars every single week to make sure that we spread more and more awareness about financial markets and what's going on, any new opportunities or investment trends. And next week is going to be a different topic, a different session. But till then, if you want to discuss about this report more and want to know more opportunities or more strategies, you can look in. This is just a very brief snapshot of what we have prepared. If you come to our office and sit with us and want one-on-one guidance, we are definitely open for consulting with you. And this is something which we do absolutely free of cost. So if you have something in mind, please come and talk to us, and we'll definitely be able to help you out. So once again, thank you so much, guys. Thank you so much for attending this session. We'll meet you next week with a different topic. Till then, please talk to your relationship managers who have reached you out, and you can take a copy of this report. And if you don't understand anything, please schedule your session one on one, and I'll be definitely available to answer all your questions. So you have a great night. See you.